Pandemic? What pandemic? Good morning, traders. It is Friday, June 5th, and we are 200 S&P points from the all-time high. It's pretty incredible to believe, but we had a really good jobs number this morning. Turns out that 2.5 million jobs were added. A loss of 11 million jobs was expected. They were looking for an unemployment rate somewhere around the 20% level. Came in at 13%, so much better than expected. That actually agrees with what we saw from ADP. There we saw 2.5 million jobs lost in the private sector on Wednesday when that number was reported. Again, they were looking for a number closer to 11 million lost. Huge disparity. It looks like people are going back to work. We had ISM services and ISM manufacturing come out this week. Now, those are surveys. Those are not backward looking. These are surveys. So they tend to forecast what's going to be happening. Both numbers came in much better than expected. China, in fact, put their PMIs out. The manufacturing and services PMIs both came in above 50, which indicates economic expansion. That's important because China's the litmus test for the rest of the world. They've had their economy open since April. They're gaining traction. So it's all systems go right now. It looks like we're going to have pent-up demand. It looks like consumers are ready to get back on track. Everything is coming up roses, and we had this huge gap higher this morning. S&P futures were up somewhere around 75 points. Let's take a look at that right now. Now, I want to stay on this daily chart for just a second. You can see how we have this upward sloping trend line right here, the red line. If I also draw one across the tops right here, I'm going to use the trend tool to do that. And we're going to draw that right here. And we'll draw across that top right here. And we'll auto extend it. And if we do that, you can see how this upper trend line has been breached right here. When you have an upward sloping trend line and we go above the upper band, that means that we're probably getting close to a buying climax. So if we see another long green candle and another one, we should be ready to see a pullback back into this upward sloping upward trend. Now, does that mean that you should go out and buy puts right now? No, 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 no. No. This market is so strong right now. What that means is that if you've got a lot of long positions and they're very profitable, that you should start scaling out of them. Take profits, go to cash, reduce risk. When we get that pullback, we want to see a nice pullback back into this upward sloping channel, and then we want to wait for support. The next best trade on a swing trading basis will be off of that dip to rejoin the upward trend and to get long at an excellent entry price. So this tells me that we're getting a little ahead of ourselves. Bullish speculation, probably overheated. We have to have bullish speculators flushed out. Again, that pullback back into this range is what we'll be looking for. So right now, my swing trade exposure is fairly light. We are short out of the money bullish put spreads. We've been doing that aggressively, actually even before the market low in here. And we've been selling them all along, but right now we only have about 4 open positions. So pretty light as far as risk exposure. Yes, we're generating income. Yes, we're enjoying this rally. I plan on making my profits intraday from here in until we get that pullback. And yes, I will have 1 or 2 bullish put spreads that I put on through the course of the week, but they'll be very short term in nature, only a week or 2 in duration. So I'm trying to sell that time premium inside of a 2-week window so that I have accelerated time premium decay working in my favor, and so that I can reassess what the market's doing on a continual basis. So rally looks really nice. Everything's great, but come on. 200 points from the all-time high on the S&P 500. There was some major damage done to balance sheets in the course of the last 3 months, and that is not just going to go away. I think that it's going to take quite a while for stocks to grow into their current valuations and to get through this deep trough that we're bound to see in Q2. And so I think that as the market starts to get higher, we're going to see more resistance. Now, I just heard President Trump today say that they are considering another round of PPP, really directed at workers, really directed at small businesses. So you can expect more stimulus. You can expect more quantitative easing, loose monetary policy. That's the safety net that asset managers are leaning on. So any dip will probably be pretty shallow, and probably be pretty brief, but it would come off of an overextension, which I think we're getting a little heated. So we want to see us come back into that range right now. Cash is king. If you have cash, you're not trying to manage losing positions. You're on the sidelines waiting for opportunity. And as soon as it presents itself, we're back in. So my approach right now, day trade from the long side, be passive with your overnights, relatively small on the swing trades. So let's take a look and see what we've got. I'm going to start off by going into the 5-minute chart, and I'll show you what I think is going to happen. And I'm also going to show you that I'm not just going back and looking at charts after the fact, that I'm actually doing real-time analysis while everything's forming, and I'm telling my members how we should position ourselves. So here's the chat room, and you can see that here we're about 50 minutes into the open. And here we've got this market drop getting less likely. We needed follow through right away on that long red candle, but the market bounced. So that means that we're not ready to see a reversal. If we were going to see a reversal, it would have to happen very, very early. First 45 minutes of trading, that window started to pass. So let me go and show you exactly what I was looking at. So we had this gap higher, and then we had this long red candle. Warning sign, warning sign. But you could see how the market was able to instantly recover, and we should have seen another red candle and another red candle soon after if this was going to be a top. But that's not what happened. The market found a bid. We had a couple of tails under body right here, and that is a sign of support. So this red candle was just a little bit of profit taking to shake out some bullish speculators, and then the bid strengthened again. Now, while all of this was happening, we had a compression, so we were in a nice, tight trading range, and the 1OP indicator was falling from this high right in here. What does that tell us? That tells us that normally the market would be pulling back with this type of price action from the indicator, but because it did not fall back, it meant that we had a bullish divergence, that prices were compressing, and that we were going to release to the upside. So I'm going to go back into the chat room. I'm going to show you that conversation. We are passing the critical juncture where a gap reversal was possible, but it's not going to happen. Now that we are compressing with the 1OP indicator falling, we are much more likely to drift higher. Well, I didn't just say it. I went in and I traded it. And I'm just looking for my entry. I did buy the S&P 500. And there you can see it. Long the SPY, 318.50. Do a price check on this. This is an hour and 10 minutes after the open. Caught that really nice move higher. Look for stocks that have been floating higher, and that was during the market compression. Those will be your best bets. That release right there was fantastic. So let me tell you what I think is going to happen the rest of the day. And I actually mentioned this in my pre-open market comments. Said a compression is likely early in the day. We're going to float higher. Then we're going to establish a trading range. We will have a little pullback in the afternoon. That pullback is likely to check this 319.50 support level. And as we get about 2 hours from the close, that dip is the one that you want to buy today, because we are likely to rally and close near the high of the day. And very late in the day, you know it's expiration Friday. I love doing option lottery trades. If you're watching this video on YouTube, you want to know what an option lottery trade is, query my channel for option lottery trades. We buy options for pennies in the last hour of trading on a Friday, and 200-300% gains on those are normal. Most people will lose money on this strategy because they are not patient. There are a number of variables that you need to look at. Everything needs to set up perfectly, and when it does, this is a very low-risk strategy because we're buying options for pennies and we're selling them for 20, 30, 40, 50 cents. So please watch those videos. You'll learn more about doing option lotto trades now that option implied volatilities have come in. that strategy is once again viable. But in the last 2 months, when we had super high option implied volatilities right into the close, even in the last hour of trading, wasn't viable. We also had mile wide bid ask spreads on these options, also not possible. We want to buy these options for 10, 15, 20 cents. Really depends on the price of the underlying stock. Yes, I'll pay $1 for options on a Google, but if you've got a really expensive stock, then yes, you need to pay more for those options. But we're looking to buy them cheap, 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 cheap. And they have the chance to really explode higher. So anyway, option lottery trades. Let's go in and take a look and see what we've got cooking today. First, I'm going to start off with the stocks that I showed you yesterday. I like to do that every day. I try to because I want you to get a feel for how accurate my research is. MU was one of the stocks that I highlighted yesterday. I love this breakout above major moving averages. Stock was near its high of the day. You can see here the stock finished the day very well, even though the market had pulled back yesterday. Market made a new low yesterday. Let's put that SPY overlay up. And you can see, look, the stock closed near its high of the day. Look what the market did. Pulled back, pulled back, pulled back. So I like MU. You can see that today it's trading considerably higher, and the stock is actually making a new high of the day as we speak right now, and it's got excellent relative strength. So during this market pullback, what did the stock do? Paused, went sideways. As soon as the market found support, whoosh, like gasoline on a fire. Let's take a look at that daily chart. Beautiful. This is our edge, relative strength. That's what we trade. So let's take a look at another stock that I showed you yesterday, GILD. And you can see GILD right here, long green candle closing on its high, pretty close to the closing price yesterday. Now, if you were day trading this is where the video came out. Hello, huge gain. So after a big run like that, yes, the stock is taking a little bit of a breather right now, but that stock went from $75 to $78. There's $3 gain if you day traded this yesterday. It was a really nice pick. COST, I'd mentioned very choppy stock, and I do like it, but I like it a little bit better for selling out of the money bullish put spreads because it's so volatile. You can see this stock is basically where it was yesterday. It ran up a little bit from the video, pulled back with the market. It's been unchanged today, and you can see very, very choppy price action, but I like selling a bullish put spread below that 100-day moving average at the 306 level. Another one, pretty decent. Qualcomm was the other stock that I had shown you. I showed you this a few days ago. I loved selling that bullish put spread down in here on these major moving averages. I actually sold a June regular expiration 79.78 bullish put spread for 20 cents. That's doing extremely well right now. So super nice trade. Again, this is to give you a feel for my analysis day in and day out. I think if you go back and you watch the video and you check all the stocks that I highlighted, I think you're going to see that this systematic approach has a lot of validity to it. So let's see what we can find for today. I've got a few stocks that I'm going to show you. We've had such a big market run up that I'm not going to go pounding through a bunch of lists. I'm going to go right into Pop Bull. If I scan down through this list, I'll see a couple that I like. MRO looks really good. I like this breakout right here through horizontal resistance. It's filled the gap right here. The opening from today should be support. The 100-day moving average should be support. This is a laggard, so you need to be a little bit careful with it. But I think this stock continues to do well. You can see that nice breakout and that support right in there. If you wanted to, that's a cheap stock. It's $7.34. So you don't need to trade options on this stock. Just buy the stock. Let it ride higher. I think that somewhere around the $9 level, as you start to approach that 200-day moving average, that's where you can probably look to take profits on it. But I think it continues to do well. The stocks that I would avoid any of the retailers. You know, I'm seeing JWN run. I'm seeing lots of laggards like RCL, CCL. Those are all the cruise lines. The airlines are running like mad. I think these companies have tons of damage done to their balance sheets. I mean, they have got astronomical losses that they're going to have to overcome. The passenger traffic is starting to come back. We heard that from UAL yesterday that they're starting to see lots of ticket purchases, so much better than expected, but still a long road to recovery. So I would avoid those. I think those stocks are really getting ahead of themselves. Simon Property Group, largest real estate investment trust company for malls in the country. You can see it's above the 100-day moving average. I'm not biting. I think that a lot of people are shopping online, and I think that the brick and mortar retailers are really going to struggle because people are even more likely now to purchase online after COVID-19 because they got really used to just going online and ordering and having the packages delivered to their doorstep. So avoid some of the laggards that are in travel, entertainment, restaurant. Focus on other stocks that are in tech, healthcare. I think those will be much better opportunities for you. I do like energy. I think energy is going to do quite well. ABBV. I showed you this stock yesterday. I showed you that relative strength in the video. If you don't believe me, please go watch yesterday's video. You can also check all the other symbols I showed you. I said yesterday, look at the stock. It's got really nice relative strength. And you can see yesterday it was starting to push higher when I did the video from here. And that's about where we got to look at it. It continued to move higher, doing really well today. Well, the daily chart has improved significantly. Here you can see we're through the upward bound of this horizontal resistance. Stock is on its high of the day. I like it. You can see relative strength right in there. Market down, stock up. That's it. That's what we look for. That's what Option Stalker helps us find. I think there's some other stocks that are interesting. I think I saw Merck getting above the 100-day moving average earlier today. Yes, but it's got the 200-day in front of it, so I would not want to be long that until it can get through the 200-day. Take a look at Cisco. Cisco's got a nice head of steam. It's above that 200-day moving average. It's a real grinder. This stock does not move very fast. I think it's a decent play. HD was one that I showed you last week. I showed you this breakout right here. I believe I showed you that on Monday, but I was mentioning selling an out-of-the-money bullish put spread. That's doing really well. Let's see what else we've got here. Intel looked kind of interesting to me also. You've got this nice little compression right here, this price compression. We have a horizontal breakout, horizontal support now, and now the stock is breaking out. That puts us at about the $61 price level. I think you could probably try a bullish put spread below that $61 level. If you wanted to play it really safe, you could go down to the $59 strike price and be below the 100-day moving average. But you're not going to get a lot of credit. You're going to have to go way out in time. So that brings me to another point. This is a really important point. So you can see option implied volatility is coming in. You can see stocks that are grinding higher, but because the implied volatilities are coming in, it means that we're taking greater risk because to get the credit that we want, we have to go closer to the money. And that means that it's even more important for us to focus on stocks that still have a lot of upward momentum and that are still very close to that horizontal support level. So in this case, if I were looking at Intel, I probably could get a decent credit at the $61 strike price, but I probably won't be able to get one at the $59 strike price because we just don't have the option premiums to support that. So let's go in, let's put up the trade button in here, and let's take a look at what we might possibly have on the Intel, and we'll go to normal option expiration, and we're going to take a look at the Intel $61 puts and the $60 puts and see what kind of credit we can get. That would be 2 weeks worth of exposure. Click on the 60s, click on the 59s, and there you can see that that spread is currently 8 cents bid, offered at 10 cents. With a dollar between the strike prices, I really need to get a 20-cent credit for that. And I'm not getting it. You know, I could go up to the $61 strike price. I'm going to click off of that. And I'm going to click that off. If we go to the $61 strike price, sell the 61 puts, buy the $60 puts. There you can see it's 11 cents bid, offered at 14 cents. Still not worth it. Not worth doing that trade. So my point is, I'm going to go back to the S&P 500 chart. I'm going to put that up for you. As the market climbs up here, as the market gets overextended, you can take a look at a chart like Intel. And what most traders will do is they're so dang anxious to get a trade off that they'll look and they'll go, well, I can't get anything decent for the 6160 put spread 2 weeks out, so I'll just sell one that's 4 weeks out. Okay, fine. And then you get a nice big market pullback into the middle of the range, just like I told you, and they're eating crow because they're going, gosh, dang it, look at that stock pull back. It looked so good. You have to be patient. You have to be patient when you're putting these trades on. So if the market goes to the moon, we have a new breakout to a new all-time high. I'm sitting on the sidelines. I won't even think twice about it. It's okay. And that's the mark of a good trader, is you have to be willing to let trades go by if the probability is not setting up for you. And I look at this chart right now, and I could tell you I loved all the news. I thought it was fantastic. But I think all the good news is already priced in. I think that as Q2 earnings results start coming out, every CEO said Q2 is going to be worse than Q1. There's going to be some serious damage in Q2. People are going to look at the valuations and go, you know what? This price might be fine in Q3 or Q4 at the end of Q4 based on future earnings, but not right now. I can't justify that valuation right now. And so the stocks naturally pull back to where they need to be. There's a lot of excitement in the market right now. Be patient. So your overall strategy right now should be, hey, I've been long. I've been making great money. Start scaling out of your long positions. Take profits. Let some of it ride. And then when you're in cash and you're really happy with the money that you've taken, then sit back and watch. I don't believe we're going to have a runaway rally that never looks back ever. I think we're going to get a pullback in here. Maybe it's a small, very brief one, but a pullback of any magnitude, even just one long red candle like that, that's all I need. Just get me back about 50 to 80 S&P points, and I'm ready to reload. And as soon as I see that buyers are still lined up, I'll reload in a big way. And instead of selling out of the money bullish put spreads, if option implied volatilities continue to come in, I will actually be a call buyer. That's how I plan on playing it. We still need some clarity. We still need to see if consumers are going to gangbuster open up their wallets and not worry about any kind of future spread of the coronavirus, or if their jobs are going to be secure once the stimulus runs out. I'm going to wait for that clarity. I'm waiting for a pullback. That's how I'm playing it right now. So I think that ABBV sets up very nicely for a long position for the rest of the day. I think it also sets up for a good swing trade if you happen to carry it over the weekend. GILD was another one that I showed you yesterday. That stock I'm not as crazy about. It's got to get through this horizontal resistance level at $78. Hey, I wanted to mention something that actually was a pretty big news item as far as I'm personally concerned. Drug company AstraZeneca, symbol AZN, they said that they are going to be making 2 billion doses of vaccine, and they are going to have it ready for distribution starting in September. Now, they're going to give 400 million doses to the U.S., which should be enough for every person in the U.S. They're so confident in this vaccine that they are willing to produce it even before it's gone and finished the clinical trials and before it has FDA approval and that it's been proven to be safe. That is a pretty dang high level of confidence. If they're wrong, they're taking an incredible amount of risk. But it's been that production and distribution for a vaccine that's the critical part. That was supposed to take another 4 to 6 months. They feel so good about their drug, they're going to produce it right here and right now and then see how the clinical trials come out. So that's pretty good news for the market as far as I'm concerned. That's one of those little news items that kind of gets swept under the carpet that I think you should be aware of. If you like this content, please give it a thumbs up. Make sure to subscribe to the YouTube channel and turn on your notifications. You'll never miss these trades, and I promise you in every video I'm going to have a new trade for you. And if I see something really good, I may do a Saturday night video. I might do a Sunday morning video. I'm probably going to do a Sunday night video. So if you turn on your notifications and subscribe, you'll be ahead of the game. You'll be armed with some trades before the opening bell Monday morning. Thanks so much. Have a great weekend, everyone. Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education. So make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.